Hello and welcome to AI Market News by LM. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Welcome to today's deep dive. We're taking a really close look at the global financial markets today. And the big focus, obviously, is that Federal Reserve decision everyone's waiting for. We've pulled together insights from various news, commentary, market data. Our mission to really boil it down, find the key takeaways, and get us all up to speed quickly on what's actually driving things right now.
Yeah, it's pretty fascinating, actually. Today, September 17th, 2025, we're seeing this convergence of so many things. You've got the big currency pairs, EURUSD, USD-JPY moving. You look at U.S. equities, the macro indicators like FedWatch, the Fear and Greed Index. It's a really complex picture. So yeah, our goal is to unpack not just what's happening, but maybe why it matters for us.
Okay, let's jump right in then. The absolute main event, the Fed's interest rate decision. Based on the prepared resources, it looks like bond traders are, well, they're positioning pretty aggressively. Expectations for at least one 50 basis point cut by the end of the year.
Right, 0.5%.
Yeah. And for today, the base case seems to be that 25 basis point cut, 0.25%. But like you said, with that strong retail data we saw, some are even whispering about maybe 50 basis points today. So is the actual cut kind of the boring bit here, as some commentators are suggesting?
That's a really good way to put it, because while, yes, that 25 basis point cut, taking the rate forecast down to 4.25% from 4.50%, that's widely expected, probably priced in mostly. The real drama, as our input sources put it, is really in the details.
Okay.
We're looking closely at the FOMC's interest rate projection, the dot plot.
The dot plot, right, where they map out future expectations.
Exactly. And just as importantly, what Jerome Powell signals in that press conference at 2:30 p.m. Eastern. Because the market right now, it's pricing in 3 cuts this year, total.
Wow, 3.
And another 3 next year. They're aiming for a terminal rate somewhere south of 3%. So the big question is, will the Fed's own projections actually match that? Or will they push back against these, frankly, quite dovish market hopes?
And here's where it feels like it gets even more tangled. We're seeing, based on the sources, really unprecedented pressure on the Fed. Stephen Miran, the White House economic advisor, he's joined the board now.
Right.
And the expectation is he'll actually push for even bigger cuts than the consensus.
A dissenter pushing for more cuts.
Yeah. And then there's this whole situation with the administration appealing to the Supreme Court, trying to remove Fed Governor Lisa Cook.
Which is huge.
If that happens, it could apparently shift the FOMC majority towards Trump appointees by February. That could impact veto power over regional Fed candidates too. So, what does this do to the idea of Fed independence?
Well, if we connect that to the bigger picture, this whole conversation starting up about a potential third mandate for the Fed.
A third mandate, beyond inflation and employment.
Yeah, pursuing moderate long-term rates. Miran mentioned this idea. It could imply, more QE-style bond buying. Basically, the Fed stepping in to keep government borrowing costs down.
Which sounds potentially inflationary.
Exactly. There's a greater inflationary risk there. And markets usually see that kind of clear political influence as a negative. Ironically, trying to force rates down could actually make long-term bond yields go up eventually.
Right. Because of the inflation risk and loss of credibility.
Precisely. And this whole fight over Fed independence, it's not getting resolved today. This is something that's going to play out over months, maybe longer. It's fundamental.
Okay, so shifting gears a bit, but related, currencies. With the Fed expected to cut, how's the dollar holding up?
Well, holding up might be the wrong phrase. It's getting quite a workout.
Okay.
According to the prepared resources, the dollar's breaking some key support levels ahead of this expected cut. It hit 2022 lows, and now it seems to be eyeing 3-year lows on the Bloomberg Dollar Index.
So definite weakness.
Oh, yeah. And that's causing ripples everywhere.
Like in the euro-dollar pair.
Absolutely. Euro-USD is a key one to watch here. It's broken through its highs for the year, trading around a 4-year high, actually. A lot of ex-watchers are now talking about 1.2 being in sight. It crossed 1.18 yesterday.
And that euro strength, does that connect to European stocks? I think I saw something about weakness there yesterday.
It has been linked, yeah. European equity weakness yesterday, though the futures are trying to catch up a bit today. Meanwhile, you look at USD-JPY, the yen's also strengthening against the dollar. It briefly touched 146.28 yen. That's its strongest since mid-August.
And the Chinese yuan?
The offshore yuan is strengthening too. It's actually close to erasing all the losses it's had since Donald Trump was elected.
Wow, so that's a combination of Chinese stimulus and the weaker dollar.
Seems to be, yes, domestic stimulus plus broad dollar weakness. So what does this all mean for us as investors?
Right, what are the implications?
Well, it really makes us think. A significantly weaker dollar, it doesn't automatically help the Eurozone economy, which is, let's face it, already struggling. Think about German industry, for example. A stronger euro makes their competitiveness issue even harder.
So that could actually lead to pressure on the ECB to cut rates again.
Potentially, yes. Could see renewed ECB cuts next year. Their next meeting is set for October 30th. And looking further out, this dollar trajectory, some analysts think it could fall another 10, maybe 20% over the next few years. That's seen by some as a huge macro driver. Could even kick off a whole new cycle for emerging markets.
A major potential shift then. Okay, let's turn to equities. The U.S. markets, S&P, NASDAQ, Dow. They saw slight dips yesterday, September 16th. S&P 500 closed at 6606.76, NASDAQ 22333.96, Dow 45757.90. Futures look kind of flat to softer today, waiting on the Fed, obviously.
Really mode.
Exactly. But the S&P is still basically at record highs.
Oh.
I saw a Bank of America survey mentioned 58% of fund managers think global stocks are undervalued. How does that square?
Yeah, it's a bit of a head scratcher, isn't it? On one hand, valuations are incredibly high, S&P multiples larger than ever. But then you have experts like Patrick Armstrong from RBC Capital Markets mentioned in the sources. He still expects equities to be higher by year end, basically driven by liquidity, just money flowing in.
Liquidity pushing things up despite valuations.
Seems to be the argument. But the real story capturing attention, especially over in Asia, is this AI boom.
Ah, yes, the AI narrative. That's definitely got legs, particularly in Chinese tech lately.
Huge momentum there. Based on various news commentary, the HS Tech Index hit a 4-year high, highest since 2021. You saw Chinese tech stocks like Baidu rally over 18% today, SMIC up 6%.
What's driving that specifically?
It seems to be excitement around their own in-house chip designs and AI model developments, apparently rivaling things like DeepSeek. Oh, and Oracle share spiked too, after being named as part of that TikTok consortium.
Right, the TikTok deal. We'll come back to that. But this AI enthusiasm, is it sustainable?
Well, that raises a really important question. There's massive optimism, huge structural spending going into AI, but you also have warnings. Like Jack Selby from Peter Thiel's family office mentioned in the commentary. He's warning the AI euphoria could be the biggest bubble that we've ever seen in private tech investing in modern times.
Wow. Comparing it to the dot-com era.
Exactly.
Yeah.
Where lots of companies just didn't make it. The challenge for companies like OpenAI, their revised cost estimates are apparently $80 billion over the next 4.5 years.
80 billion.
Yeah. The challenge is monetization. Will these massive capital investments actually lead to sustainable profits? And for China specifically, yes, they're stimulating their economy. Chinese tech valuations look attractive. But those geopolitical risks, the potential for a US-China loggerhead, that's still a big concern for foreign investors.
Okay, let's pivot slightly to the broader macro picture again. That U.S. retail sales number you mentioned earlier.
Yeah, the August data.
It really defied expectations, didn't it? Up 0.6%. That's the third straight monthly rise.
Consumers are still spending. As one piece of commentary put it, like, it's going out of fashion, even though sentiment surveys look weak.
And it seems like the top earners are driving a lot of that.
That's a fascinating detail from the sources, yeah. The top 10% of earners drove almost half, 49.2% of total consumer spending in Q2.
Highest since 1989.
Exactly. And that kind of robust spending definitely complicates things for a Fed trying to pivot dovish. It's a mixed signal.
Absolutely. And connecting that to inflation, still a concern, right?
Yeah,
Especially outside the U.S.
definitely. If we look at the UK, for instance, their August CPI came in at 3.8%. That was in line with expectations. Core CPI, stripping out food and energy, was 3.6%.
So still quite high compared to others.
Much higher. The Bank of England is widely expected just to keep rates on hold at 4.0% through year end. They seem pretty cautious because of sticky services, inflation, and other factors.
So the UK is kind of an outlier.
Yeah.
Compared to maybe 2% inflation in Europe, 3% in the U.S.
Yeah, it stands out. And this whole picture feeds back into those concerns about the Fed's credibility and independence, especially if we end up in a sort of stagflationary environment, high inflation, slow growth. That's the nightmare scenario.
Meanwhile, geopolitics just keeps bubbling away in the background. Or sometimes foreground. President Trump's state visit to the UK is happening now.
Second one, right.
Yeah, and it coincides with these huge investment pledges from U.S. tech giants, Microsoft and OpenAI, Google, NVIDIA. for UK tech infrastructure.
Yeah.
Billions of dollars.
Big money flowing in.
But those steel tariffs, 25%, still in place.
It's still a sticking point.
Yeah. And some commentary suggests there might be some awkward background conversations too,
Not really.
potentially around historical links like the Epstein connection.
Always layers to these visits.
Always. And speaking of complex deals, that TikTok situation is back in the news.
Right, the consortium, Oracle, Silver Lake, Andreessen Horowitz.
They're set to manage the U.S. operations. ByteDance holding less than 20%.
But the details still seem fuzzy. Algorithm licensing, the final valuation.
Still open questions. And the deadline got extended again.
Yeah.
To December 16th, 2025. That's the fourth extension.
Fourth time. Tells you how tricky this balancing act is. National security, business, tech dominance.
Indeed. And while we're talking about different national approaches, Japan, they're in a unique spot, aren't they?
Very unique. While everyone else is cutting or holding, the Bank of Japan has a policy decision this Friday, September 19th.
What's the expectation there?
Well, it's interesting. You have one LDP leadership candidate pushing for easy money. Demand for 20-year government bonds is strong, but the general expectation is probably no rate hikes. Too much political uncertainty right now.
Is everyone agreed on that?
Not quite. Some economists are actually making bold calls for BOJ hikes as soon as October.
Really? Why?
Because Japan's labor market is unusually tight right now, very different from other major economies.
Huh. So Japan's definitely one to watch, another outlier.
Absolutely. A fascinating contrast.
So with all these moving parts, Fed expectations, currency swings, AI booms, geopolitical tensions, how's the overall market feeling? How do we gauge sentiment?
That's where indicators like the CNN Fear and Greed Index come in handy. It's a useful barometer for us. It pulls together 7 different indicators to give a snapshot.
Okay, what sort of things does it look at?
Things like market momentum, comparing the S&P 500 to its 125-day moving average, stock price strength, net new highs versus lows on the NYSE, market volatility, that's the VIX, the fear index. It's currently at 16.66, up a bit today, plus 1.83%.
Okay.
And also things like safe haven demand, or people rushing into bonds, for example. It updates as new data comes in, so it gives a pretty real-time sense of whether fear or greed is dominating.
So understanding those signals is important.
Oh, absolutely vital. They reflect the collective mood, the emotions driving investors. If we combine that kind of sentiment reading with fundamental analysis, it can really help us assess the market and maybe avoid getting swept up in biases.
Right, keep a level head.
Exactly. And given all the mixed signals we've talked about, strong retail sales versus maybe a weak labor market, sky-high equity valuations versus hopes for a dovish Fed, keeping track of these sentiment drivers is going to be really key for navigating what's ahead.
Makes sense. Okay, before we wrap up, let's quickly look at the economic calendar for the rest of today and the next couple of days. This is from investing.com, all times U.S. Eastern.
Okay.
So today, Wednesday, September 17th. At 2:00 p.m., that's the big one, U.S. Fed interest rate decision, forecast 4.25%, plus the FOMC statement and those economic projections, including the dot plot. Then at 2:30 p.m., Jerome Powell's FOMC press conference. Later, 5:30 p.m., Brazil has an interest rate decision, forecast 15.00%. Quite a contrast.
High rate there.
Yeah. Then tomorrow, Thursday, September 18th, we get the Bank of England interest rate decision. The previous rate was 4.00%. And Friday, September 19th, that's the Bank of Japan policy decision. Previous rate, 0.50%. Also on Friday, keep an ear out for news on that expected phone call between President Trump and President Xi Jinping about the TikTok framework.
Lots happening in just a few days. It's definitely a packed schedule.
So, as we've seen, it's such a dynamic picture out there, often contradictory signals. The next few months really promise this fascinating clash between what the market wants or expects, what central banks actually do, and of course, the wild card of politics.
Right.
The big question lingering is, can the Fed actually navigate all these pressures successfully? Or are we maybe standing on the edge of a really unprecedented shift in monetary policy and global market dynamics, maybe even, as we touched on, the start of a whole new cycle for emerging markets? It's a lot to think about.
It really is. What a deep dive today. Hopefully this gives us all a much clearer grasp on the complex forces shaping the markets right now. We hope it's provided some clarity and maybe sparked even more curiosity for everyone following along. Thanks for watching. Don't forget to like and subscribe.